Aussies are doing it tough right now, but we need to get our revenue up. So let's come up with some new taxes. What do you got?
It's so true.
If you have a property in your self-managed super fund, there's zero tax when you retire. 15% while you work, but once you retire, there's no tax.
When you hold the property all the way through to pension phase, obviously no capital gains tax, but there's also no tax on the income.
So you're probably asking, why do people want to buy property under SMSF? Well, that's because maybe they prefer property over stocks and they're more comfortable in investing in properties rather than stocks.
Shares can be volatile and you really do need to understand shares when you're investing in them.
For the most part, I would say 90+% of Australians, they would actually have zero idea what their superannuation is actually invested into.
And he is right. Most clients that we talk to don't really know where their funds are invested. Welcome to SMSF Insider, where we help busy professionals to gain financial independence using an SMSF. Hi, I'm Troy, founder of Blue Chip SMSF Services. And over the last 20 years, I've helped thousands of Aussies manage the complexities of self-managed super funds. And in this podcast, I'll answer your questions, break down the myths, so you can take charge of your financial freedom. Let's get into it. Hey guys, just a quick disclaimer and just a reminder that this is not personal advice. So make sure you speak with a licensed advisor before making any investment decision. Welcome to this edition of SMSF Insider, where I'll be opening up some links to some social media content and giving my opinion on what I see.
Buying a property in your self-managed super fund. Here's what you need to know. Remember, this is not financial advice. This is just generalized information, and you should definitely speak to a licensed professional. Now, my experience using self-managed super funds to buy property is that it can be extremely lucrative. For the most part, I would say 90+% of Australians, they would actually have zero idea what their superannuation is actually invested into. People know that it's in an industry fund, for example, but they don't understand what that industry fund is investing in.
Yeah, so just briefly, Jack's talking about, firstly, about purchasing property through an SMSF and that it can be a lucrative strategy, which it can be. We've been doing this strategy for well over 10 years and we've got some clients who've done extremely well with this strategy. And he is right. We do have most clients that we talk to don't really know where their funds are invested. They know that it's with an industry fund or Australian super or whatever the super account is, but they really have no idea where the funds are invested. Is it in a high growth fund? Is it in a growth fund? Is it conservative? Is it balanced? Is it spread across a multitude of different funds? Have I updated my beneficiary details? It might even not even have their current address details. So people are typically a little bit out of touch when it comes to where their funds are invested.
And a lot of the time, they're not taking advantage of leverage. And if done well on a long enough time horizon, using leverage to your advantage when investing in property can be extremely lucrative, like it has been for myself.
Yep. I have to agree with him there. As I mentioned, we have been doing this strategy, or clients have been doing this strategy, clients of ours for well over 10 years. And all of those clients have typically done very, very well.
So first things first, from my experience, the first thing that needs to be done before buying a property inside of a self-managed super fund is setting up the correct structure. Now, a good accountant and financial planner will be able to assist you with this, but for compliance reasons, there are certain structures that need to be set up in order for you then to operate a self-managed super fund. Now, once the structures are set up correctly, then it's about directing our contributions into the super fund. Now, to maximize what I can do inside of my super fund.
Yeah, so when you are establishing a self-managed super fund, get in touch with a professional and make sure that they've got some experience in this space. So chat to either an accountant or financial planner or an SMSF specialist who does or has had some experience setting up SMSFs. He's a bright young kid. I think he's from what it seems, he's done very well for himself. He's very knowledgeable and certainly looks like he's got a lot of experience in the when it comes to purchasing property. So I think he's a bright young kid, and I think he's done quite well for himself. So good on him.
Hey Chris, I'm looking at buying some property. Are there benefits of buying it with my self-managed super fund?
Yeah, good question. What's the benefits really? There's the one where you've already got usually a good deposit built up from all your contributions. So it's quite easy to get a loan in a super fund because you're borrowing money in the fund and therefore you've got the equity there. The other thing too is that borrowing in the super fund really doesn't affect your other borrowing.
Chris is right. Most people do have quite a bit of savings in their super fund, and it is quite a good strategy purchasing property through your fund with the ability of leverage. As I mentioned previously, we have been doing this strategy for well over a decade, and or our clients have been, and they have done extremely well over that period of time. But yes, certainly borrowing through an SMSF to purchase property can be a good strategy, and it is a good way if you have maxed out or you don't have enough borrowing capacity, or the bank won't lend you any more money outside of super to purchase an investment property. Then certainly having exposure using your SMSF can be a good way to if you're wanting exposure to the property market, using your super, setting up an SMSF and purchasing property can be a good way to get that exposure. Yeah, and also, when you are purchasing property, as Chris mentioned, when you are purchasing property in your through your SMSF, it's not going to affect your borrowing capacity outside of super. If you are wanting to have further exposure to property, then your borrowing in through super doesn't affect that borrowing capacity or your ability to borrow outside of super. It's completely separate. So good point by Chris.
In your own name, borrowing the super fund won't cut across that loan, so it's actually a good separation there. Also, once you've got your property in the super fund, any income you make, any net income after expenses, is only taxed at 15%, which is pretty good. And also, any capital gain down the track is 10%. So it's a good way to strategise your real estate investments. Very straightforward. Good accountant, good planner, good broker. It's a piece of cake.
Chris is talking about the tax rate. Certainly, through an SMSF, the tax rate is only 10% once you've held the property for more than 12 months, and the income is taxed at 15% as opposed to your marginal tax rate when you're purchasing it outside of super. So, yep, very good strategy, and one that we've seen time and time again.
And what's the gearing on self-managed super funds?
80% is achievable. 70% is normally what they say. It depends on what other assets you've got in your super fund and the type of property. So all the normal things that are good.
Yeah, so when they talk about gearing, saying what sort of deposit do you require for an SMSF? Certainly anywhere from 20 to 30% is fairly typical, all the way up to 50%. Yeah, so that's when Chris is talking about gearing there, he's talking about how much should I borrow, whether that be 70% or 80%, which is fairly typical. Most lenders will lend up to 70 or 80%. So yeah, that's a fairly common one.
Depends on what other assets you've got in your super fund and the type of property. So all the normal things that are good, broker would look at. But
so you would borrow 70% or 80% of the purchase price when borrowing in your super fund. Yeah. That's a lot more than I thought.
No, look, sometimes if you're getting the right advice, people might say be conservative, make it 50 or 60. Because you've got to remember.
He also mentioned in there about that 70 or 80% is quite aggressive. But certainly, yeah, previously we have seen gearing as low as 50%. Most clients were in the early days were gearing around that sort of 50% mark, but banks will lend up to 80%. It really depends on your individual circumstances. So do reach out to seek some advice around what gearing is going to be right for you. And but yeah, that strategy certainly we've seen it quite a lot.
Borrowing criteria for SMSF. There's a few different things. There's only a number of lenders that can lend in SMSF. And they all have different rules and things as part of their policies. And number one is majority of the lenders will allow you to lend up to 80%, and some of them are less, right? Depending on what type of asset you're buying, whether it's a house or apartment.
Yeah, so there are only a few lenders in the market with when you're talking about a limited recourse borrowing arrangement. There's only a handful of lenders out there that do lend in this space, and the gearing levels are up to about 80%. We don't really see any clients or any banks, I should say, lending more than 80%. Yeah, certainly there are only a few lenders in that limited recourse borrowing arrangement space.
Like for example, one bank with apartments will only take 65% as an LVR, a loan to value ratio. But for the same asset, another bank would take 80%. So it just depends. One lender will also say that they need some money in cash or shares left over.
Yeah, so every bank is different. They will will have different lending requirements. So speak to your broker about the differences between lenders, and I'm sure they'll be able to point you in the right direction.
So you're probably asking, why do people want to buy property under SMSF? Well, that's because maybe they prefer property over stocks and they're more comfortable in investing in properties rather than stocks, because stock market is just too complicated these days. And they have more knowledge investing in property.
It is a good point. Some people do feel more comfortable and do understand property more than shares, and that may be because the asset class is tangible, you can see it, and certainly most Australians have had a positive experience with property over the longer term. So shares can be volatile, and you really do need to understand shares when you're investing in them, and obviously property as well. But I think the thing that spooks people about shares is it is quite a volatile asset class. Super high growth, so it can shoot up very quickly, but can also come down very quickly. Property is obviously a little bit more of a stable asset class, a little bit more defensive, and people do tend to understand a bit more. I think that is why most people do lean towards property over shares. Not saying that one is better than the other. They're both just very different. Some people do prefer shares, some prefer property. Everybody is different. Reach out to your financial planner, and they'll be able to helping you decide which asset class is best for you.
Because it's a lot easier for them to research in certain areas, vacancy rates, growth rates, what infrastructure is in place, etc. And the second thing is they probably find more value investing in property rather than stocks, because the last few years, the property prices have actually boomed up.
Yeah, so property prices have boomed in the last few years, and it doesn't look like it's slowing down anytime soon. That's purely, I think, because of the supply demand. There is far less supply than what there is demand, but it's not property isn't the right the silver bullet that is going to fix everyone's investment solutions. Everyone is very different. So reach out and seek some advice and some guidance before making investment decisions. Just quickly, guys, if you're a busy professional, fed up with traditional super funds and overwhelmed by the setup of your SMSF, we can help. Book in a call with my team using the link in the show notes, and let's build your future on your terms. Now, back to the episode.
Because people don't realize it, but as long as you've got property in your name and hold on to that property for the rest of your life, you'll be taxed. However, if you have a property in your self-managed super fund, there's zero tax when you retire. 15% while you work, but once you retire, there's no tax.
Yeah, so this gentleman's talking about taxation of property inside of super. Certainly when you hold the property all the way through to pension phase, there is obviously no capital gains tax, but there's also no tax on the income. So the rent that property is distributing on a monthly or a weekly basis is all tax-free, versus property when you're purchasing in your own name. If you're holding that all the way through to retirement age in your personal name, all of that income will be taxed at your marginal rate.
Even the SMSF strategy video, which for me is the most powerful video in that entire course, how I build my SMSF and how I build my clients' SMSF. For me, it's like one of the most powerful things that any Australian could go out there and do in their portfolio. If you follow that game plan, that guideline, in my opinion, like anyone can create serious wealth. And the way I look at it is a second portfolio.
Certainly purchasing property through super can be a great strategy. You will need some guidance around firstly setting up the fund, and also some guidance around which property to purchase and which property is going to be most suitable for your fund. So reach out, get some guidance, and before making any investment decisions.
Labor's new super tax, it's not about taxing the rich, it's about screwing the rest of us. And I'm going to break it down for you. Labor is introducing a tax on super balances over $3 million. Right now, about 80,000 Australians will be affected.
Yeah, so what this guy's talking about is the $3 million unrealized capital gains tax, which is looking like it will be passed through the Senate, which means every super fund that has a balance more than 3 million will be taxed an additional 15%. So it'll be taxed at 30% for amounts over 3 million. There is a calculation to use if this is going to affect you. It only affects a small portion of the population at the moment, but there is a calculation. If you want some information on that, we do have an episode that breaks all that down, so you can scroll back and you'll see how that is actually calculated. But what this gentleman is talking about is the $3 million unrealized capital gains tax.
So over time, more and more Aussies will get dragged into it. Petrol, that's up over 30%. Housing.
What he's talking about here is the $3 million threshold that is currently being proposed is not indexed. So it means that over time, it'll start to capture more and more people. So it might not capture it at the moment. It'll only capture a small percentage of the population. But as time goes on, obviously it'll slowly start to capture more. Of course, there are governments can introduce indexation on the cap, and that may happen over time. But certainly the incentive will be to raise more revenue and not to raise less revenue. So I can't see the cap coming down. Certainly it'll be going up as time goes on.
That's up over 30%. Housing, in some areas, up over 40%. Groceries, still climbing. And our dollar getting printed into oblivion by an incompetent government with soaring debt levels. So yeah, 3 million might sound big right now, but in 5 to 10 years with inflation like this, that number won't be unrealistic at all.
Yeah, so he's right. There are some inflationary issues domestically here in Australia as well as globally that obviously central banks are trying to fix with raising rates. But certainly over time, 3 million won't be a lot. And if you're a retiree at the moment with 3 million in super and you require full-time aged care, it's not hard to rip through 150K a year in full-time care, and there is quite a percentage once you get of Australians over that 80 years of age. There are a higher percentage that do require full-time care, and 3 million it might be generating 150 grand a year, but full-time aged care is expensive and can certainly far exceed 150K a year, which is an estimate on roughly how much a $3 million portfolio will generate in income. But certainly as time goes on and Australians get more and more and become older, they will require, some of them will require full-time care, and it is, as I said, it is quite expensive. So it might seem 3 million might seem like a lot at the moment, but in 5-10 years' time, 3 million certainly will seem a lot less.
Aussies are doing it tough right now, but we need to get our revenue up. So let's come up with some new taxes. What do you got?
How about we raise income tax?
No, leave that. It's already at 45%. They're practically working for free.
How about any time they invest their money into an asset, we tax them on half when they sell?
Yeah, we already do that. It's called capital gains tax. Come on, we need something original.
I love these guys. It's so true.
What about money they make in a business?
Company tax, already got that.
What about when they pay their employees? Can we sting them there?
That's payroll tax, and we've been stinging them since 2007.
What if their boss gives them perks like a company car?
Yeah, fringe benefits tax, we're already getting that. Come on, think.
What about petrol? They can't drive without it.
Yeah, fuel excise tax.
It just goes on and on, doesn't it?
Every litre.
What about super? Can we tax their retirement savings?
That's super tax. We tax that coming in, we tax it coming out. We've got that covered.
All right, hear me out. How about we raise GST to 15%?
Now we're talking. I'll write that down. We'll circle back to it. 15%.
Yeah, GST probably the next one to be increased.
I just want to buy a nice car. Can we get some of that?
LCT, baby, luxury car tax.
Stamp duty?
Got it.
Council rates?
Every bloody quarter.
More toll roads?
Yeah, we're milking tolls.
Alcohol and cigarettes? Why can't we tax it more?
Yeah, we're taxing that to the moon.
Yeah. Yeah, I do love these guys. We do get taxed a lot here in Australia. We are one of the most highly taxed countries in the world.
Hey, Jack.
Yeah.
Are people earning over 190K stupid if they don't own investment property?
Yes, absolutely they're stupid, because the reality is your $190,000 probably goes down to like 120-ish net, which means you're losing $70,000 to the beautiful people called the Australian Tax Office.
Yeah, so Jack's talking about the taxation benefits of owning property. If you're on a higher tax bracket and you're earning $190,000 a year, you're obviously paying about $70K in tax. And when you do own assets like property in your own name, you can get some tax benefits from doing that. But certainly reach out to your advisor or financial planner before making any investment decisions.
And then with the 120 that you've got left over, you then got to go and live. And it's people like you, Katie, they have to go to Europe and they've got to go buy all these expensive things. So by the time you're actually negative at the end of the year, you've just got a credit card that's got a debt on it, which you don't want. So what you should do, you should go buy investment properties, and you get this beautiful thing called negative gearing and depreciation, which means the $70,000 of tax that you pay to the ATO.
Yeah, so Jack's talking about here negative gearing and depreciation, which is Any property will have, certainly the newer properties will have depreciation, so you'll be able to claim some tax back on or get some depreciation on newer properties as opposed to the older ones, and negative gearing. So if the property is costing you more than it's making, then you can claim that negative component, and that's called negative gearing. If you are a high income earner and you've got the ability to negative gear and purchase these assets to get some tax breaks, then certainly you should talk to your advisor about doing that. But the cost of living these days, I mean, some people are, as Jack's mentioned here, paying $70,000 in tax. They're netting 120, and then they've got to pay things like school fees and mortgages, and cost of living is forever going up. So, I think the strategy, it's a good strategy, but certainly you want to get some advice before jumping in. Thanks for tuning in to this episode of SMSF Insider. If you got value from this, make sure you subscribe so you never miss the strategies we share to help you take control of your financial future. Find us on socials at Blue Chip SMSF, or book a call with our team to see if we can help you.